Welcome back to Talk Tickers. This is the deep dive where we strip away the noise, we try to ignore the clickbait, and we get straight to the business of understanding what is actually moving the markets.
Right, because there's always a lot of noise.
There is. Always. We are the Professionals Earnings Call Summarization Service, and we're really glad you're here with us today.
It is good to be back. And today we have, a pretty fascinating case study on the desk.
We certainly do. We are turning our attention to a company that, quite frankly, usually flies completely under the radar for the average retail trader.
Yes.
But if you were watching the tape yesterday, you just couldn't miss it. We are talking about API Group, ticker symbol APG.
Yeah, APG.
Yeah.
The quiet giant of industrial safety.
That's a good way to put it. So we are reviewing the Q4 and full year 2025 results. These were released yesterday morning, so that was February 25th, 2026. And before we even dive into the spreadsheets and the numbers, we have to talk about the price action.
Oh, absolutely.
Because usually when you hear, industrial services or fire safety, you expect a stock chart that looks like a flat line.
Right. You expect a defensive stock, a very utility-like grind, just slow and steady. But yesterday was different.
It was electric. I mean, we saw an immediate sentiment check right out of the gate. Pre-market, the stock popped about 1.76% to around $45.78. But here is the key, and you know this better than anyone. It didn't fade.
No, it didn't.
Often you see that morning pop and then the profit taking sets in by 10 a.m. Not here. It followed through in the regular session, hitting a brand new 52-week high of $46.89.
And if you look at the volume, that tells the real story, because you can get a price pop on low volume and it's basically noise, right? It's a retail flush.
Yeah.
But yesterday we saw heavy volume. We're talking about 4 million shares traded versus their average of about 2.3 million. So that is nearly double the normal activity.
It is massive for them.
It's huge. That tells me this wasn't just, day trader Dave chasing a green candle. That is institutional conviction. That is big money stepping in and saying, we believe this story, we want to own this asset.
Exactly. And the vibe I'm getting, and we're going to unpack this extensively over the next hour for you, is that this isn't some speculative tech rally. This isn't an AI hype cycle kind of thing. This is what you call a competence premium.
Oh, I like that. That is the perfect phrase for it. The market tone right now is definitely bullish to constructive, because API Group basically walked into the room and said, we told you 4 years ago we would do X, Y, and Z, and guess what?
Yeah.
We did exactly that.
In a market full of misguidance and continuously revised targets, simple execution is a premium asset right now.
It's the most valuable asset.
So let's look at the scoreboard. This is our results snapshot segment.
Yeah.
What exactly did the market like so much? Let's start with the headline numbers.
It's a beat. Everyone loves a beat.
They really do. Revenue for the fourth quarter came in at $2.12 billion. The street consensus was sitting around $2.09 billion, so they comfortably beat the top line. That is a 13.8% jump year over year.
And we really need to pause on that number because the composition of that growth is critical. 11.1% of that was organic growth.
Right. And let's clarify that for the listener who might be, a bit newer to industrial analysis. Why does that organic distinction matter so much?
Because in this industry, it is very easy to just go out and buy growth. You can take out a loan, acquire 5 smaller regional companies, and staple their revenue to your income statement.
Just bolt it on.
Exactly. That's inorganic growth. It looks great on paper, but it doesn't mean your core underlying business is healthy. Organic growth, on the other hand, means you are selling more to your existing customers, or you are winning brand new customers with your existing team.
Which is much harder to do.
Much harder. Seeing double-digit organic growth in a mature, somewhat sleepy industrial sector is incredibly rare. It signals that they're aggressively taking market share from their competitors.
That's a great distinction. So the top line is undeniably healthy. Now, looking at the bottom line, adjusted EPS came in at 44 cents. The street was expecting 42 cents, so a solid 2-cent beat there. But the number that I think really got the analysts excited, and I know you want to talk about this, is the profitability.
Adjusted EBITDA. It came in at $295 million for the quarter. That's up 22% year over year. But the real story, the story that actually drives the valuation and the multiple, is the margin expansion.
Q4 adjusted EBITDA margin hit 13.9%. That is up 90 basis points year over year.
To put that in perspective for you, in the industrial services world where you're dealing with labor costs, fuel costs, truck fleets, equipment maintenance expanding margins by nearly a full percentage point in a single year is heavy, heavy lifting.
It's not a software company where the marginal cost of a new user is zero.
Exactly. It shows real pricing power. It shows they aren't just taking every low-margin job that comes across the desk just to stay busy. It shows they're managing their input costs aggressively while simultaneously charging a premium for their service.
And this wraps up their full year 2025. Net revenues hit $7.9 billion. But there was this moment on the call, and in the release itself, which felt like a real promise-kept moment, they had this framework they've been talking about for years.
The 1-360-80 framework. This was their long-term guidance from all the way back in 2021.
Right. Let's break that down, because they didn't just hit it, they kind of crushed it.
Right.
And this is really the foundation of the entire bull case right now.
So the 13 stood for a 13% adjusted EBITDA margin. Back in 2021, a lot of analysts thought that seemed pretty ambitious. Well, they came in at 13.2%. Target exceeded.
Yeah.
Then the 80 stood for an 80% free cash flow conversion rate.
And again, for the non-CFA listeners out there, free cash flow conversion is essentially asking, out of all the profit you report on paper, how much of it actually ends up as hard cash in the bank.
Exactly. It's the ultimate quality of earnings metric. You can have high paper profits, but zero actual cash if you have to spend it all on inventory, or if your customers just aren't paying their bills on time. API Group targeted 80%, which is a best-in-class standard for industrials. They hit exactly 80%.
And the 60.
The 60 was a dual target regarding their leverage ratio and revenue mix, specifically looking to get net debt leverage down while bringing recurring revenue up. And they have done that remarkably well, which we will definitely touch on when we get to the balance sheet section.
Yeah, we have a whole segment dedicated to that.
But primarily, hitting that margin and cash flow target creates massive credibility. When management says, in 4 years, we will be exactly here, and then 4 years later they deliver, that buys you a tremendous amount of trust on Wall Street.
Trust translates directly to multiple expansion. People are willing to pay more for a dollar of earnings if they inherently trust the people managing that dollar.
Precisely. They get the benefit of the doubt.
And they aren't stopping there. They issued forward guidance for 2026. Revenue guidance is $8.4 billion to $8.6 billion. Adjusted EBITDA is expected to be between $1.14 billion and $1.20 billion.
And here is the kicker on the guidance. This is the number that likely caused some spreadsheet models to be frantically updated overnight. Free cash flow conversion is expected to surge to roughly 115% of adjusted net income.
115%. How do you even convert more than 100% of your income into cash? That sounds like a typo.
It does, right? But it usually comes down to working capital management, basically collecting cash from your clients faster than you pay it out to your vendors. And it's also the difference between depreciation, which is a non-cash accounting charge, and your actual physical capital expenditures. Essentially, it means they are running an incredibly capital-efficient machine.
They don't have to build a billion-dollar gigafactory to grow.
No, they don't need massive factories. They just need vans, tools, and highly trained technicians. It's a cash machine.
Okay, so the table is clearly set. The numbers are undeniably good. The stock is at an all-time high. But we need to understand how they are doing this. It's time to go deeper.
Let's get into the mechanics.
This is segment 1 of our deep dive. We have to talk about the strategy, because for a long time, the story was 1-360-80. But now that they've conquered that peak, they unveiled a brand new North Star on this call. They're calling it 101-660 plus cent.
It's catchy, but let's decode what that actually means for the business.
The 10 is $10 billion in revenue by 2028. The 16 is a 16% plus adjusted EBITDA margin. And the 60 plus is having 60% or more of their revenue coming from inspection, service, and monitoring. We call that ISM.
This is a fundamental shift in the corporate narrative. And if you're a listener trying to understand why this matters to the stock price, you have to look at the business model evolution.
Yeah.
Historically, API Group could be viewed by some as a really, really efficient general contractor.
Right. You bid on a project, say, installing fire sprinklers in a brand new sports stadium. You build it, you get paid, and then you have to go out and find another project to replace that revenue.
The hamster wheel.
Exactly. It's highly cyclical. If the overall economy slows down, construction stops, and your revenue just dries up. And it's lower margin because you are bidding against 10 other hungry contractors for the initial job.
But this shift to Mono 1760 Plus signals a total transition. They want to be a high-margin, recurring revenue service compounder. They want to be the people who come in and check the fire alarms every single month, not just the guys who install them once and leave.
And they're making serious progress on this. The ISM revenue mix moved from 40% back in 2021 to 54% in 2025.
That is a massive swing for a company of this size. Over half the business is now that sticky recurring service revenue. And the goal is to push that well over 60%. This is the quality of revenue argument we always talk about. Wall Street pays a significantly higher multiple for service revenue than it does for construction revenue. That's just a fact of the market. Service revenue is predictable. It acts like an annuity. Construction revenue is lumpy and risky.
So that leads us perfectly into segment 2, the inspection and service engine. Because management talked a lot about this flywheel effect on the call. Can you explain the actual physics of this flywheel?
Sure. It's the absolute core of their growth engine right now. It all starts with the basic inspection. Because of local fire codes, state laws, and heavy insurance requirements, every commercial building must have its systems inspected regularly. Annual, semi-annual, sometimes quarterly, depending on the facility.
It's not optional. A facility manager can't just decide to skip it this year to save a few bucks on the budget.
Right, or their insurance is voided and they get shut down. So API Group sends a technician out to do the mandated inspection. That's revenue event number 1. But here is the magic of the model. While doing the inspection, the technician invariably finds a corroded valve, or a smoke sensor that is failing, or a water pump that needs preventative maintenance.
Which immediately becomes revenue event number 2.
Exactly. And they detail the math on the call. It's fascinating. For every $1 of inspection revenue they generate, it pulls through $3 to $4 of subsequent service work. It's the perfect self-funding lead generation tool because you are already physically in the building. You are the trusted expert standing there with the clipboard telling the manager, hey, this is broken, and if you don't fix it, you're officially out of compliance.
And the customer essentially has to say yes right then and there.
They have to. It's non-discretionary spend. And the growth here is just impressive. Inspection revenue grew double digits in Q4. Now, management did note, and I really appreciate the intellectual honesty here, that they have had over 20 consecutive quarters of double-digit growth in inspection.
That is a wild streak. 5 full years of double-digit growth in a seemingly boring sector.
It is, but they warned analysts that the law of large numbers is going to kick in eventually. It simply gets harder to grow at 15% when you're a multi-billion-dollar unit compared to when you're a $100 million unit. So they expect that percentage growth to moderate slightly going forward, but the absolute dollar amount being added to the top line is still enormous.
And they are aggressively fueling this engine with M&A.
Yeah.
This isn't just organic growth we're talking about. They completed 14 acquisitions in 2025 alone.
14. That is more than one a month on average. That requires a machine-like integration capability at the corporate level.
And they just closed a brand new one in February 2026 called CertaSite.
CertaSite is a very interesting case study because it fits this new 101 in 60, 60-plus model perfectly. It's an inspection-first platform based in the Midwest. They aren't buying big construction firms that pour concrete anymore. They are specifically buying these service-heavy operators to feed that exact flywheel we just talked about. They are effectively buying regional customer lists.
The CEO, Russ Becker, said something on the call that really stuck with me regarding these acquisitions. He pitched API Group as a forever home for these founder-led businesses. Is that just corporate fluff for the PR wire, or does it actually matter financially?
It matters immensely in the private M&A market. You really have to put yourself in the shoes of a founder for a second. Let's say you've spent 30 years building Smith Fire Protection. You know every single employee, you know their families, but you want to retire. You usually have 2 options. Option 1, sell to a private equity firm. They will likely fire your middle management, strip out costs, load the company up with debt, and flip it to someone else in 3 years.
Not a great legacy to leave behind for the people who helped you build it.
No, it's brutal. Option 2, sell to a strategic long-term buyer like API Group. Russ Becker's pitch is, we are an operating company. We want to keep your people employed. We want to grow your local brand. We are your forever home. If you can convince a founder of that emotional aspect, you can very often acquire the company at a lower multiple.
You don't have to be the highest bidder if you are perceived as the best buyer.
Exactly. It allows API to engage in what we call multiple arbitrage. They buy these small regional companies at 5 or 6 times EBITDA, and then instantly, once integrated, that same revenue is re-rated at API's public trading multiple, which is a much, much higher. It creates instant shareholder value.
It's a brilliant culture play that translates directly into a hard financial advantage. Huh? Now, let's pivot to segment 3 because we have to talk about the elephant in the room, or maybe the server rack in the room. Data centers.
Oh, yeah. It was the major topic in the Q&A session. Every single analyst on the queue wanted to know about their data center exposure.
And the trajectory they laid out is clear. Data centers were 5% of total revenue in 2024. They grew to 8% in 2025, and they're projected to be 10% of the entire business in 2026.
So it is effectively doubling as a percentage of a rapidly growing pie in just 2 years. That is hypergrowth hiding within an industrial company. But what's fascinating here is the moat around this specific business. Russ Becker made a strong point that this isn't just installing basic ceiling sprinklers in a generic warehouse.
Right, these aren't your average suburban office buildings.
Not at all. These are hyperscale campuses. We are talking about massive facilities that consume as much power as a small city. The heat density in these modern server halls, especially with the new AI chips from NVIDIA and others running constantly, is off the charts. You can't just spray water on a $50 million server rack if there's a small short circuit. You destroy the asset entirely.
So the fire suppression has to be incredibly high-tech.
Extremely high-tech. It involves complex early warning detection systems, pre-action sprinkler systems, and sometimes advanced chemical suppression like FM200 or nitrogen systems. The technical requirements and the precision needed are incredibly high. You need a level of engineering sophistication, massive bonding capacity, and global geographic reach that your local mom-and-pop fire safety contractor just completely lacks. API Group is one of the very few players large enough and sophisticated enough to handle these global hyperscale accounts.
And the revenue mix is what makes it beautiful for their long-term model. Yes, the initial construction projects are huge and drive a lot of immediate top-line revenue, but once you install that highly bespoke system on a massive server farm, who's going to service it?
API Group. They are permanently embedding themselves for the long-term, high-margin service contracts on these critical facilities. And think about the leverage they have. If a data center goes down because of a fire system malfunction or false alarm, the cost is astronomical. We're talking millions of dollars per hour in lost compute time and SLA penalties. These hyperscale clients, the Microsofts, the Amazons, the Googles, they are not price sensitive when it comes to life safety and asset protection. They are purely performance sensitive.
That brings up a great point about margin discipline. Because even with all this booming demand, they aren't just taking every data center job that comes their way.
No, they are being incredibly selective. Gross margins actually expanded 110 basis points in safety services, hitting 37.7%. And in specialty services, they expanded an incredible 190 basis points.
They had a huge jump in a single year.
It really is. And it all comes down to what management calls disciplined project selection. They explicitly said on the call that they are entirely willing to walk away from low-margin work. They are actively using the tight skilled labor market as leverage. They know there is a massive national shortage of skilled pipe fitters and technicians. So they are going to the market and saying, if you want API Group's technicians, who are widely considered the best in the business, you have to pay the premium.
They're pricing up their services simply because they can.
Exactly. They are effectively firing their bottom-tier, low-margin customers to free up capacity for the highly profitable work.
Classic supply and demand at work. Now, moving to segment 4, the balance sheet. Because obviously, all this organic growth and all these acquisitions require fuel.
And they have plenty of fuel. This was one of the most interesting financial takeaways for me. Their net debt to adjusted EBITDA ratio is currently sitting at 1.6x.
1.6x. For context, is that exceptionally low?
For a company with this kind of highly predictable recurring cash flow, yes, it's arguably inefficiently low. Their stated long-term target is to operate between 2.5x and 3.0x leverage.
So they are significantly underlevered right now. They essentially have the room to borrow billions of dollars without upsetting the credit rating agencies at all.
Significantly underlevered. And that implies massive dry powder for 2026. They have the room to borrow, and they have that 115% free cash flow conversion, constantly refilling the coffers.
Which naturally begs the question, what are they going to do with all that capital? The analysts on the call were pressing them pretty hard on whether a chunky deal is coming down the pipe.
Right, chunky being Wall Street slang for a large transformative acquisition. Not just the little regional tuck-in deals like CertaSite, but something that moves the needle on day one.
And the CEO didn't shy away from it at all. He said they were actively looking at larger deals. Specifically, he mentioned life safety, security, and this is a really interesting one, elevators and escalators.
That elevator vertical is the absolute key to watch. They bought a company called Elevated previously, which established a decent foothold for them. Now they're heavily signaling they might want to go much, much bigger in that space. And he was very clear on capital priorities. M&A comes first, share buybacks come second. They want to buy growth.
Speaking of elevators, that leads us perfectly into segment 5.
Yeah.
The operational nuances and the human element. Because there was a specific personnel move announced that might have flown under the radar for some casual listeners, but I know you caught it buried in the details.
Oh, yeah. Adam Fee.
The VP of Investor Relations, he is moving to a finance leadership role within the elevator business.
Now, usually when an IR guy moves, it's not headline news. It's inside baseball. Usually an IR executive leaves to become the CFO of a smaller public company. But Adam Fee has been the public face of this company to Wall Street for 3 years. He knows the strategic vision inside and out. Moving him internally into an operational finance role, specifically in the elevator division, is a very, very specific signal.
What's the signal you're reading there?
It tells me they are dead serious about elevators. You do not take one of your top corporate financial talents and hide them in a niche division unless you plan on making that division a behemoth. It shows they are injecting high-level financial rigor into that newer vertical. To me, it suggests they are actively preparing that specific division for a massive scaling event, likely a very large acquisition that will require sophisticated, heavy-duty integration. It's a bullish signal on their internal culture and mobility, but it's a flashing neon sign regarding their strategic M&A roadmap.
They also touched on AI during the call. And I really loved the management's pushback on the standard narrative here. They aren't viewing AI as some existential threat to their labor force.
Right, because you can't ask ChatGPT to go fix a broken sprinkler head in a ceiling. You can't ask an LLM to physically wire a complex fire alarm panel. The physical world is still the physical world.
Exactly. They view it purely as an enabler. They actually stood up a dedicated and internal AI team, but the stated goal is just to remove mundane tasks. They want their highly paid technicians out billing customers, not sitting in the van filling out compliance paperwork for 2 hours a day.
It's all about operational efficiency. If an AI tool can seamlessly handle the scheduling, the daily reporting, the complex compliance logs, then that technician can spend an extra hour a day actually turning a wrench. That is direct, high-margin revenue falling straight to the bottom line. It's margin expansion achieved through technology, not labor replacement.
And finally, before we look at the broader context, we have to mention the milestone. 2026 marks the 100-year anniversary of API Group.
A full century. It's symbolic, sure, but management used it very effectively to frame their overall resilience. This is essentially the Lindy effect in corporate form, the idea that the longer something has survived, the longer it is likely to survive in the future. They've managed through the Great Depression, World War II, multiple severe recessions, the COVID pandemic, crazy inflation spikes, supply chain tariffs, and they are still here. And frankly, they are bigger and more profitable than ever. It really reinforces that safety and stability narrative for institutional investors who are currently terrified about the macroeconomy.
Okay, let's zoom out a bit. That's the deep dive into the quarter and the mechanics. But what does this actually mean for you, the investor? This is our investor context segment.
I think the overarching thesis here is simply boring is beautiful.
Explain that for our listeners.
Look, APG isn't out there reinventing the wheel. They aren't inventing a revolutionary new microchip. They are systematically consolidating a highly fragmented, legally mandated industry. Fire and life safety. It's totally unsexy. It's dirty work. It involves fleets of vans and guys on ladders. But the market reaction hitting a new all-time high strongly suggests that investors are currently craving reliable cash-flowing compounders. They are exhausted by speculative growth stories that blow up every earnings season. They want predictable free cash flow.
The valuation check is really interesting right now, too. With the stock sitting at around $47 and about 441 million shares outstanding, the market cap is steadily climbing. But they are trading entirely on execution credibility now. They've earned their multiple.
And if you look at the sector comparison, the outperformance is just stark. APG is up 66% over the last trailing year. The broad industrial sector ETF, the XLI, is only up about 21%.
So they are literally tripling the performance of their own sector.
They are crushing it. And the underlying reason is decoupling. They're actively decoupling from general industrial cyclicality because of that 54% service revenue mix. Think about it. If the broader economy slows down, developers might stop building new factories, which hurts the general XLI components, but the facility managers cannot turn off the fire alarm systems in the existing buildings. They still have to pay APG. That deeply protects APG's downside while they continue to capture the upside through M&A.
And we absolutely cannot ignore the backlog number they reported. over $4 billion in backlog.
That's a massive financial safety net. That is high-quality revenue that is already contracted and booked, but just not yet billed. And management explicitly cited green shoots in industrial activity early in 2026. They are flat out defying the widespread fears of a macro slowdown. They simply aren't seeing a recession in their proprietary data.
So we have a record year, all long-term targets hit, forward guidance raised, and a massive war chest of cash ready to be deployed for M&A. But now we have to get a little creative. It is time for our This Is Not Financial Advice segment.
Always my favorite part of the deep dive.
Standard disclaimer for you listening. We are not financial advisors. This is purely for entertainment and educational purposes. Do your own due diligence. Do not execute trades based solely on what two people on a deep dive say. But if you are a hedge fund analyst pitching a wild, high-conviction idea to the investment committee today, what is the trade?
Okay, I've got one. I'm calling this the elevator to heaven leveraged bet.
Elevator to heaven. I'm listening. Walk me through it.
Here's the setup. We know APG is fundamentally underlevered. They're sitting at 1.6x debt. They explicitly want to be at 3.0x. That represents billions of dollars of untapped borrowing capacity. We also know they have a stated taste for chunky M&A. And crucially, we know they just moved their star corporate IR guy, Adam Fee, directly into the elevator division's financial leadership.
The breadcrumbs are all right there in plain sight.
Exactly. So the trade is buying 2027 lead easy long-term equity anticipation securities, specifically out-of-the-money call options targeting a sudden volatility spike.
Why leap easy instead of just holding the common equity?
Because the broader market is currently pricing APG as a steady Eddie compounder. It expects slow, boring, predictable growth. The options chain is not pricing in a massive transformative acquisition in the elevator or escalator space. Imagine they wake up tomorrow and announce a $2 billion deal to buy a massive slice of a global major's divestiture, like a giant carve-out from a UTC or a similar conglomerate.
The synergy machine narrative would instantly kick into overdrive. Wall Street loves a good synergy story.
Exactly. You aren't playing the next quarterly earnings beat with this trade. You are playing the balance sheet re-leveraging event. If they announce a massive unexpected deal, the stock drastically reprices, implied volatility spikes, and those cheap Evelyn could absolutely go to the moon. You are betting on the boardroom taking a massive swing with all that dry powder.
I like it. It's aggressive, but it's logically sound based on management signaling. I have an alternative pitch for you, though. I call this the data center gets pair trade.
Okay. Let's hear it. I love a good pair trade.
You go long APG, and you go short a basket of generic commercial real estate REITs with heavy traditional office exposure.
The classic new economy versus the old economy setup.
Exactly. Traditional office space is dead or dying. Vacancy rates are still incredibly high in major metros. But data centers, they are the undisputed new Class A real estate. But here is the catch. Physically building the concrete shell of a data center is a fiercely competitive, low-margin business. And owning the empty downtown office tower is a massive depreciating liability.
But the guy coming in and checking the specialized sprinklers every month?
The recurring safety inspections on a billion-dollar AI server farm are the single highest quality rent-seeking behavior in the entire market. So you go long, the guy checking the sprinkler that's APG, and you simultaneously short the guy holding the bag on the empty commercial office tower. It's a perfect delta-neutral hedge against the broader real estate market, while aggressively betting on the high-margin guts of the digital infrastructure boom. You are effectively stripping out the underlying real estate risk and just purely playing the safety premium.
That is a highly sophisticated pair trade. You're betting purely on the critical function of the building, rather than taking risk on the building itself.
Precisely. Well, there you have it. A truly record year for API Group.
A full century of business, every major target hit, forward guidance raised across the board.
A management team that seems to be operating with a lot of genuine gratitude and, importantly, a whole lot of cash.
Which is a very dangerous combination for their competition.
It really is. Management mentioned their gratitude for reaching the 100-year anniversary. I think it's safe to say the shareholders are feeling plenty of gratitude themselves, with the stock sitting at all-time highs. Keep watching the tape. This has been Talk Tickers.